Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. We are recording this episode on Saturday, February 22, 2026. Last week, the S&P 500 rose 1.1% and the Nasdaq jumped 1.5%, snapping a 5-week losing streak as markets reacted to a landmark Supreme Court ruling on Friday, February 20, 2026. The court struck down the administration's sweeping Liberation Day tariffs, ruling that the president exceeded his authority under the International Emergency Economic Powers Act.
The ruling triggered an immediate rally in trade-sensitive sectors, particularly for import-heavy retailers and tech giants like Amazon, which saw its shares jump more than 2%. Investors celebrated the potential for improved profit margins and the prospect of over $160 billion in tariff refunds for U.S. importers.
Despite the relief, a new era of uncertainty began as President Trump immediately announced a replacement 10% global tariff under different legal authority, which he later suggested could rise to 15%. As the market heads into next week, focus shifts to high-stakes earnings from NVIDIA and Salesforce, alongside the State of the Union address on February 24.
Yeah, and it is definitely going to be a fascinating week for the broader market, considering all those moving parts.
Absolutely. But today, we're steering our ship away from that domestic drama and setting our sights across the Pacific. We're doing a full deep dive into Sea Limited, ticker symbol SE.
Right.
And this is the Singaporean tech giant that has been described by a lot of analysts as the Amazon, the Tencent, and the PayPal of Southeast Asia, all rolled into one massive company.
It really is a fascinating conglomerate. I mean, you have Shopee for e-commerce, you have Garena for gaming, and SeaMoney, which is now rebranded as Money for their fintech arm.
Yeah.
And the mission for our deep dive today is pretty specific.
Right, because the landscape is shifting fast.
Exactly. We need to unpack how this company is navigating the current market volatility and specifically look at their massive recent pivot into something called agentic AI. We really want to figure out what you, as an investor, need to know before their critical fourth quarter earnings report drops on March 3rd, 2026.
So let's unpack this, because the news cycle around Sea Limited has been, well, it's been absolutely frantic this week. We have to start with the breaking news from just a few days ago, Thursday, February 19th.
Right.
Sea Limited announced a major strategic partnership with Google, and they keep using this phrase in the press releases, agentic AI. Now, I know AI is everywhere right now, but this feels fundamentally different from the chat interfaces we've been using. What exactly is agentic AI?
It is a significant distinction, and it's crucial that we define this clearly for everyone listening because it is not just marketing fluff. For the last couple of years, we have been in the era of generative AI.
Language models.
Exactly. LLMs. These are chatbots. You ask them to write a poem or summarize a long email or write some Python code, and they generate that content. But agentic AI is the next evolution. It's not just about generating text anymore. It's about taking action. An AI agent acts on behalf of the user to complete complex multi-step tasks.
Okay, so it has agency.
Yes, it has agency, it has a goal, and it figures out the individual steps required to achieve that goal without you having to prompt it at every single stage.
Okay, let's put this in concrete terms so we really visualize it. Because if I go to a chatbot today and ask, what are the best running shoes for flat feet? That is a research task. It gives me a list. What would an agent do differently?
Right, so an agent takes that research and converts it into execution. Instead of just asking for a list, you would tell the agent, buy me a pair of running shoes for flat feet, keep it under $150, and make sure they can be delivered to my house by Tuesday.
Wow.
And then the agent goes to work. It searches the marketplace, compares the prices, checks your size history from your previous purchases to make sure they actually fit, reads the reviews to filter out the junk, checks the logistics and shipping times to hit your Tuesday deadline, and then actually executes the transaction if you've authorized it to do so. It bridges that massive gap between knowing what to do and actually doing it.
That sounds incredible for the consumer. And they are building a prototype of this for Shopee right now with Google. But what about the other parts of the business? Because you mentioned Garena and Money.
Right. It's an ecosystem-wide integration. For Garena, which is their gaming side, they are using this agentic AI to enhance game development productivity. We are talking about automating coding and asset generation.
Which is incredible labor-intensive normally.
Exactly. Modern mobile games require thousands and thousands of 3D assets. Trees, textures, character models, weapons. If an AI agent can generate these base assets or debug the code in the background, it allows the human developers to focus entirely on gameplay mechanics and story. If they can produce high-quality game assets faster and significantly cheaper, that directly improves their operating margins.
And for Money, the fintech arm. Because trusting an AI with my money feels like a big leap.
It is a leap, but it's arguably the most disruptive application they are working on. They are piloting what they call agentic payment experiences. Imagine an AI that automates your financial life. It manages your bill payments. It optimizes your cash flow based on your spending habits, and perhaps even moves money between different accounts to maximize your interest yield.
All in the background.
All in the background, without you having to manually tap through 5 different screens on your banking app. It turns the fintech app from a passive ledger, which just shows your balance, into an active wealth managing agent.
It sounds like they are trying to completely rewire their entire ecosystem with this Google technology. But here's where it gets really interesting for us, and frankly a little confusing from a market perspective.
The stock price.
Yes. This is a high-tech, highly futuristic announcement with Google. And Google is arguably the best partner you could possibly have in the AI space. You'd think the market would love this, and yet the stock closed the week at $115. It has actually faced a 6.9% decline over the past month.
That is the big disconnect we really need to dig into.
Why the hesitation? I mean, if I heard AI partnership with Google back in 2024 or 2025, I would expect the stock to pop 10% on the day, especially in this environment where tech companies are generally rewarded for any kind of AI innovation.
Well, it comes down to the timeline of returns and what analysts are calling the CapEx conundrum, capital expenditure. The market is currently in a very strict show-me-the-money mood. Investors are looking at the promise of long-term AI innovation, which is objectively great, but they are weighing it against the immediate, tangible realities on the ground today.
Right, because AI is not cheap to build.
Not at all. Implementing agentic AI at the scale of millions of users requires massive compute power, cloud infrastructure, and highly paid engineering talent. Investors are worried that Sea Limited is about to embark on a massive spending spree to build this out. They worry it's going to hurt short-term profits just to chase a shiny new technology that might not actually pay off for 3 or 4 years.
So the institutional investors are basically looking at Forest Lie and saying, that's a very cool science project you have going on with Google, but are you selling enough physical widgets today to pay for it without burning through all your cash?
Exactly. They're weighing the shiny future against the gritty present. And those present realities include intensifying competition, specifically from Alibaba's Lazada, which is always a threat, and the absolute juggernaut that is TikTok Shop. Plus, you have rising operational costs in key expansion markets like Brazil.
So the Google deal is flashy, and it definitely helps the long-term narrative, but the market is just waiting for the hard numbers in the upcoming earnings call. They want to see if the core business is healthy enough to fund this AI revolution.
Precisely. They want to see the fortress is secure before they fund the expedition.
Well, speaking of hard numbers, to understand where they are going on March 3rd, we really have to look at where they have been. Let's rewind the tape to their last confirmed performance. That was the Q3 2025 earnings report, which came out back in November. Because that report was, well, it was a bit of a mic drop moment for the management team, wasn't it?
It absolutely was. If you want to understand the core bull case for Sea Limited right now, the reason why some analysts still maintain very high price targets, you just have to look at Q3 2025. It was a record-setting quarter across the board.
Let's run through the headline numbers.
Sure. Total revenue hit $6.0 billion. That was up 38.3% year over year.
I just want to pause on that for a second. That is nearly 40% growth for a company of this immense scale. We aren't talking about a small startup doubling its revenue from 1 million to 2 million. This is billions of dollars in new incremental revenue in a single year.
It is massive scale. But as they say in the industry, revenue is vanity, profit is sanity. The number that really matters to the market right now is the bottom line. Net income for the quarter was $375 million. That figure more than doubled year over year. And adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, basically a proxy for their operational cash flow, that was $874 million, up 68% year over year.
Okay, that is a pivotal detail. Because just a few years ago, specifically around that brutal 2022 market crash, the entire narrative around Sea Limited was growth at all costs. They were notorious for burning cash that is going out of style just to acquire users. They were heavily subsidizing shipping. They were giving away free items and games. They were outspending everyone. This Q3 report sounds like a completely different company.
That is the exact aha moment for anyone studying this stock. The pivot is complete. They have successfully transitioned from that growth at all costs mindset to a profitable growth model. And it was a very painful transition.
They had to make a lot of cuts.
They did. They laid off thousands of staff. They completely exited unprofitable markets like India and several countries in Europe, and they really tightened their operational belts. But the result is that now they aren't just burning cash anymore, they are generating it. And that disciplined approach has given them an absolute fortress of a balance sheet. At the end of Q3 2025, their cash equivalents, and short-term investments sat at a staggering $9.9 billion.
Nearly $10 billion in liquid cash. That is a serious war chest. What does a company even do with that kind of liquidity in this current macroeconomic environment?
Above all else, it gives them optionality. It means they can weather almost any external storm, whether that's a global trade war, new tariffs, or a localized currency crisis in Southeast Asia. But more importantly for the growth story, it allows them to invest in things like this massive Google AI partnership without having to go to the debt markets or dilute their existing shareholders by issuing new stock.
They can essentially self-fund their own technological evolution.
Exactly. And they are going to need every penny of that efficiency because the e-commerce war in Southeast Asia is incredibly expensive to fight.
Let's break down the main engine driving this ship then. We have to talk about Shopee. It is the largest pan-regional e-commerce platform across Southeast Asia, Taiwan, and now they have a massive footprint in Brazil. When I review the Q3 numbers, the sheer scale of the operation is just mind-boggling. Gross merchandise value, or GMV, which is the total value of all goods sold on the platform, was $32.2 billion.
And that was up 28.4% year over year.
Right. And look at the volume of transactions required to hit that number. Gross orders for the quarter were 3.6 billion.
Let's contextualize that. That is 3.6 billion individual packages moving through their logistics system in just a 3-month window. To put that in perspective, that is roughly 40 million packages being delivered every single day.
And the revenue they extracted from that core marketplace was $3.1 billion, which was up over 52%. So if I'm looking at this correctly, they are growing the raw volume of orders by 28%, but they are growing the actual revenue by 52%. That implies they are monetizing the platform significantly better than they were a year ago. They are squeezing more value out of every single transaction.
You are spot on. This dynamic is what analysts call the take rate. It's the percentage of that total GMV that Shopee actually keeps as its own revenue through commissions, fees, and ads. A rising take rate is the holy grail of an e-commerce marketplace. It proves that the merchants are willing to pay more for the service because the platform delivers undeniable value. If the platform was weak, merchants would leave when fees went up.
But they are staying.
They are staying and they are paying. And that leads us to a really crucial detail from the last earnings call that might have been buried in the reports, but is absolutely essential to keep in mind for this upcoming March 3rd report. Management officially raised their full year 2025 GMV growth guidance to more than 25%.
Raising guidance mid-year is almost always a bullish sign. It signals a lot of internal confidence.
It signals profound confidence, specifically in the face of brutal competition. Everyone in the market knows TikTok Shop is aggressively attacking them in their core markets. By raising the guidance anyway, management is effectively sending a message to Wall Street saying, we see the threat, we understand the landscape, and we are still going to beat our previous numbers.
So the obvious question is, how are they doing it? How are they managing to fight off a heavily funded competitor like TikTok while simultaneously increasing their own profit margins? Because historically in retail, fighting a price war kills your margins. You have to lower your prices or offer free shipping to keep the customers from defecting.
This is where we get into the operational weeds of logistics, which I personally find to be the most fascinating part of the Sea Limited story. It is all about SPX Express. That is their proprietary in-house logistics network. They have basically turned logistics from a massive cost center into a formidable competitive moat.
How so?
Well, in the early days of Shopee, they relied almost entirely on third-party couriers. They used DHL, they used J&T Express, they used the local postal services. But over the last few years, they have aggressively built out their own delivery infrastructure. Now they are doing a huge percentage of it themselves.
Give us the details on that, because logistics is a notoriously difficult business. What are they doing differently that makes it an advantage?
It is purely about ruthless efficiency and speed. By owning the entire network, they can optimize the delivery routes and the sortation centers using their own data. In Asia, during Q3, they managed to reduce the logistics cost per order by 6%.
6% might sound small to a casual observer.
It does, but when you are processing 3.6 billion orders, shaving pennies off each delivery adds up to tens of millions of dollars in pure operational savings that drops right to the bottom line. And in Brazil, the numbers are even more impressive. Brazil is a notoriously difficult logistical environment due to its massive geographic size and, frankly, somewhat challenging infrastructure in certain regions.
Right.
But in Brazil, they reduced their logistics cost per order by an astounding 21%.
A 21% reduction in delivery costs in an emerging market. That is massive.
Yeah.
That essentially changes the fundamental unit economics of the entire region for them.
It completely flips the script. And it is not just cheaper, it is significantly faster. Half of all Shopee orders in Asia are now delivered in 2 days or less. In Indonesia, which has terrible traffic and complex geography, they have rolled out instant delivery in under 2 hours for certain items. In Taiwan, they've deployed over 2,500 automated locker stores so people can pick up packages securely at their own convenience.
So from the consumer's perspective, if I am a buyer, I get my items cheaper and faster with Shopee than I might with a newer competitor who still has to rely on disjointed third-party couriers.
Exactly. By owning the physical logistics via SPX, they build a wall against TikTok Shop because they control the last mile of the delivery. TikTok, for the most part, still has to rely on external partners to get the box to the door. Shopee controls the entire chain from the warehouse to your porch. That control allows them to squeeze out the inefficiencies and guarantee reliability. If you are a merchant, you strongly prefer Shopee because you know the package actually arrives on time without getting lost. If you are a buyer, you prefer Shopee because the shipping is fast and trackable. That physical infrastructure is an incredibly hard advantage for a purely digital competitor to replicate overnight.
That makes a lot of sense. You can't just code a delivery truck into existence. The other thing I noticed in the Q3 report was the data on advertising. It seems like Shopee is steadily becoming less of a traditional store and more of a digital billboard.
That is the second massive lever for their profitability. It is often referred to as the Amazon model. Amazon makes billions not just from selling things, but from charging sellers to rank higher in the search results. Shopee is doing the exact same thing. Ad revenue on the platform increased over 70% year over year in Q3.
Wow.
The number of sellers actively using their ad products is up more than 25%, and the average ad spend per seller is up more than 40%.
So the merchants are actively choosing to pay Shopee more money just to get their products seen by those buyers making the 3.6 billion orders.
Yes, Shopee is evolving into a high-value media platform, and ad revenue is extremely high margin. Think about it. There's almost zero cost of goods sold for serving a digital ad. Every dollar a merchant spends on an ad drops almost straight to Shopee's bottom line. So when you combine the logistics network systematically lowering the cost and the ad platform rapidly increasing the high-margin revenue, you get that explosion in EBITDA growth we discussed earlier.
Okay, so Shopee is clearly the growth engine today. But for a very long time, the dominant narrative around Sea Limited was that Shopee loses billions of dollars, and the gaming division, Garena, is the cash cow that quietly pays all the bills. Is that dynamic still true today? Is the gaming side still relevant to the investment thesis?
Oh, absolutely. You cannot ignore Garena if you are looking at this stock. In fact, Garena just posted its best financial quarter since 2021. For a while there, the popular narrative was that Garena was a melting ice cube, meaning its core games were slowly dying off and the revenue would eventually evaporate. But that narrative is officially dead.
Really? Because my impression has always been that mobile games have an incredibly short shelf life. People get obsessed with a game, they play it nonstop for 6 months, and then they completely abandon it for the next big thing.
Usually, that is exactly how the industry works. But Garena's flagship game, Free Fire, is a massive anomaly. It is incredibly resilient. It hasn't just remained a game. It has essentially become a foundational social platform for the youth in the emerging world. Look at the numbers. Bookings for the quarter were $841 million. That is up 51% year over year. And the quarterly active users reached 670.8 million people.
That is just, 670 million. That is almost 10% of the entire world's population logging into this specific game every single quarter. That creates a level of platform stickiness that is very hard to overstate.
It is staggering reach. And what is even more important for the bottom line is the paying users. The number of people actually taking out their credit cards and spending real money on digital skins and battle passes was up 31%, reaching nearly 66 million paying users.
What is driving that specific resurgence? Free Fire is not a brand new game. Is it just the gameplay loop itself, or are they doing something different with the marketing?
It is their mastery of the live ops strategy, live operations. They treat the game like a living, breathing service, not a static product. They constantly run massive, culturally relevant collaboration events. Recently, they had huge in-game collaborations with the Netflix show Squid Game and the anime Naruto Shippuden.
Oh, that is brilliant.
Right. And these aren't just banner ads on the loading screen. They are fully integrated in-game events with custom modes, exclusive outfits, and themed weapons. It keeps the game feeling constantly fresh and relevant to whatever is trending in global pop culture.
So a hit show like Squid Game dominates Netflix, and Garena immediately captures that cultural momentum and monetizes it inside Free Fire.
Exactly. And if we connect this back to the broader thesis for Sea Limited, this is what we call the flywheel effect. Garena prints pure cash. It is a digital product with incredibly high margins. Sea Limited takes that cash flow and uses it to fund the expensive logistics battles in Shopee and to fund the credit expansion in their fintech arm, Money. Without Garena's massive resurgence, financing the growth of the other two segments would become much, much more difficult. If Garena was actually declining, Sea Limited would be forced to dip into that $10 billion cash pile we talked about. But because Garena is growing again, they're generating enough free cash flow to continuously reinvest in their own expansion.
Speaking of financing and credit expansion, let's transition to the third pillar of the company, the rising star, Sea Money, which they now call Money. From everything in our research, this feels like the quiet overachiever of the entire group.
It really is. It is exploding right now. Revenue for the fintech arm was just shy of $1 billion in Q3. It came in at $989.9 million, which is up 60.8% year over year, and their total loan book grew by an astonishing 70%, reaching $7.9 billion.
Whoa, hold on a second. A 70% increase in lending in a single year. That immediately sets off alarm bells for me. Whenever you hear about rapid credit expansion, especially in emerging markets, you have to ask, isn't that incredibly risky? Are they just handing out money to anyone with a pulse just to pump up their top-line growth numbers before earnings?
That is the natural, healthy fear to have. Historically, rapid, unchecked credit expansion almost always leads to a spectacular blow-up. We saw this clearly in the subprime mortgage crisis. But if you look closely at the actual data Sea is reporting, the non-performing loan ratio, which tracks the percentage of loans that are overdue by 90 days or more, remained perfectly stable at 1.1%.
A 1.1% default rate. That is remarkably low. I mean, that is better than the default rates at some major developed market credit card companies in the U.S.
It is absolute banking-grade risk management. It suggests incredibly disciplined execution. And this brings us right back to that agentic AI and the data advantage we talked about at the top of the show. They are using highly advanced data analytics to assess credit risk.
Because they have the Shopee data.
Exactly. Because they own the e-commerce platform, they have a massive proprietary information advantage over a traditional legacy bank. A traditional bank only sees your credit score and maybe your stated income. Money knows exactly who pays their utility bills on time. They know who has steady, predictable consumption habits. They are underwriting these consumer loans based on thousands of real-time transactional data points rather than just static, outdated credit profiles.
That makes a ton of sense. If I'm consistently buying diapers and baby formula every 2 weeks on Shopee, the algorithm knows I am likely a responsible person with a family, and therefore I am statistically a much better credit risk than someone whose purchase history consists of erratic luxury items bought at 3 a.m., or someone who constantly changes their delivery address.
Precisely. They can literally see the structural flow of your life through your shopping cart. And now, armed with that data, they're making a massive strategic shift off-platform.
What does that mean, off-platform?
It means they're extending their Pay Later credit product beyond the walled garden of the Shopee app. They want to embed their fintech solutions into everyday, real-world financial use cases. They want you paying for your lunch at a restaurant with money. They want you buying groceries offline or scanning a QR code at a local street stall using their app. They are actively evolving from a simple checkout feature into a comprehensive, standalone digital bank.
So we have these three massive engines firing at the same time. Shopee is dominating e-commerce. Garena is printing cash with gaming, and Money is rapidly expanding into a digital bank. It sounds like a perfect storm of growth. But, as you know, this is the deep dive, and our job is to look at the downside risks too. You mentioned the elephant in the room earlier, TikTok Shop. How bad is that threat, realistically?
It is undeniably the single biggest threat to the bull case for the stock. Make no mistake. A while ago, TikTok Shop acquired Tokopedia in Indonesia, which was a massive consolidation in the market. As a result of that merger, TikTok now holds approximately 28% of the total e-commerce market share in Southeast Asia.
28%.
Yes, with an estimated GMV of around $22.6 billion in 2024 alone.
That is essentially going from zero market presence to a massive existential threat in just a couple of years.
It is an unprecedented speed of acquisition. But you have to understand the mechanics of how TikTok sells. They have perfected social commerce. They seamlessly convert user attention into commerce. You are scrolling through entertaining videos, you see an influencer using a product, and you buy it with one click without ever leaving the app. It completely bypasses the traditional search bar model that Shopee was built on, and we are already seeing the impact in the data. In Vietnam, which is a critical growth market for all these players, Shopee's market share actually dipped from 63% down to 58% in mid-2025.
Ouch. Losing 5% of your total market share in a single country in 1 year is highly significant. That proves they are actively bleeding users to the competition.
It does. And the primary weapon in this battle is the subsidy war. TikTok has incredibly deep pockets. If TikTok decides to spend billions on aggressive shipping subsidies to lure users over basically offering free shipping on everything, Shopee is forced into a very tough corner. They have two choices. They can ignore the subsidies and watch their market share erode further, or they can match the free shipping offers, which directly hurts their own profit margins.
And since Shopee has spent the last 3 years promising investors a focus on profitable growth, choosing to match those heavy subsidies is going to be incredibly painful. It directly contradicts the current strategy of maximizing that EBITDA number we were just praising.
Precisely. That is the exact tension that every institutional investor is watching right now. Can Shopee successfully defend its turf by relying on its superior logistics network and delivery speed? Or will they ultimately be dragged into a race-to-the-bottom price war that ruins their hard-earned profitability?
And it's not just direct competition they have to worry about. We have significant macroeconomic risks as well. In the intro, we touched on global tariffs and trade disruptions. How does a macro event like U.S. tariffs actually hit a Southeast Asian company like Sea Limited?
It hits them indirectly, but very powerfully through the currency markets. Whenever there is global trade uncertainty or new tariffs, the U.S. dollar tends to surge as a safe haven asset. We're seeing that now. And as the dollar strengthens, emerging market currencies weaken. The Indonesian rupiah, for example, has recently slumped more than 3% against the dollar. Now remember, Sea Limited is a publicly traded company on the New York Stock Exchange. They report all their earnings to Wall Street in US dollars, but they actually earn their money on the ground in local currencies like the rupiah, the Thai baht, and the Brazilian real.
So if the rupee is worth 3% less today than it was last month, their reported revenue in dollars automatically looks smaller, even if they sold the exact same amount of physical goods in Jakarta.
Correct. It creates a constant currency headwind. You can have a phenomenally successful quarter operationally, but the math of translating those local currencies back into dollars wipes out a chunk of the growth on the spreadsheet. And then, on top of FX risks, there is inflation. Overall, inflation is forecast to be relatively low, around 2.5%. But in key markets like Brazil, where overall economic growth is softening to around 2.3%, any persistent inflation aggressively eats into consumer discretionary spending.
Right, because if people are forced to spend a higher percentage of their paycheck on basic groceries and rent, they logically have less money left over to buy cosmetic skins in Free Fire or new clothes on Shopee.
Exactly. It shrinks the total addressable wallet.
And finally, we can't forget about regulatory hurdles. Governments around the world, especially in emerging markets, love to target big, successful tech companies.
Especially when they start acting like banks. Exactly. Take Indonesia, for example. They are steadily tightening the regulatory screws. They recently introduced strict new fintech rules regarding minimum capital requirements for lenders. And they also implemented a new seller tax withholding policy of 0.5% on all turnover. That directly increases the friction and the cost of doing business for the small merchants on Shopee. If it becomes too expensive or too bureaucratically annoying to sell online, marginal merchants might just pull back entirely.
And what about Brazil? You mentioned they're growing fast there.
Brazil is a huge opportunity, but a regulatory minefield. There are constant rumblings about import tax changes that could severely affect cross-border trade. A significant portion of Shopee's early success in Brazil relied on importing cheap, unbranded goods directly from China. If the Brazilian government decides to heavily tax those specific cross-border packages to protect local manufacturers, Shopee's volume could take a massive hit overnight.
So to summarize the bear case, it is definitely not all smooth sailing. There are a lot of sharks in the water. Which brings us directly to next week, Tuesday, March 3rd, 2026, Judgment Day for the stock, the Q4 earnings report. What exactly are the analysts expecting to see?
The consensus estimates on Wall Street are currently looking for earnings per share, or EPS, of 0.90s, and they are looking for total revenue to come in at $6.78 billion for the quarter.
So if they manage to hit that $6.78 billion mark, that would represent a 36% increase year over year, which means despite all the macroeconomic headwinds and the TikTok competition, they really aren't slowing down their top-line growth much at all.
It is very robust growth. But here's where we get into the great price target debate among the analysts, because we have seen some very mixed signals from the big institutional banks over the last few weeks. Morgan Stanley recently came out and cut their price target on Sea Limited to $173. Bank of America Securities followed suit and cut their target down to $150.
But wait a minute, let's do the math on that. The stock is currently trading right around $150. So even a cut to a target of $150 is, what is that, the 30% upside from where we are sitting today.
Exactly. That is the fascinating part of the current sentiment. Even the supposedly bearish moves by these major banks are still implying massive upside for the retail investor. The analysts are clearly worried about the profit margins, specifically their fear that Sea might spend way too much capital on this new Google AI pivot, or that they'll burn cash fighting TikTok. But even the bears remain incredibly optimistic about the underlying revenue growth and their entrenched market dominance.
So the broader consensus is still positive.
Very much so. The aggregate consensus rating remains a solid buy or moderate buy, with an average 12-month price target sitting right around $181.49.
So the street is basically sending a message to management saying, we're a little nervous about how much money you might spend this year, but we fundamentally believe in the long-term growth story of Southeast Asia.
That is the perfect summary of the current market psychology, and that is exactly why the timing of the agentic AI announcement last week is so tricky to navigate. If management comes out on the earnings call on Tuesday and bluntly says, we are committing $1 billion in CapEx to AI this year, the stock might actually drop on Wednesday because of those margin fears.
Yes.
But conversely, if they can clearly demonstrate that the AI tools are already saving them money, for instance, by fully automating their customer service centers or reducing the cost of game development, then the stock could absolutely fly. It all depends on how they frame the timeline of the AI return on investment.
It's a incredibly delicate balancing act for the leadership. And leading that balancing act is Forrest Li, the CEO and founder. We have some recent commentary from him in our source materials regarding his vision for this AI pivot.
Forrest Li is a fascinating executive to study. He is traditionally very quiet, very media shy, and highly deliberate in his public statements. So when he speaks, the market listens. In the press release for the Google partnership, he stated, and I quote, "We believe AI represents a fundamental technological revolution which will create massive new opportunities for our ecosystem."
I mean, that sounds like standard boilerplate CEO speak. Does he actually mean it, or is he just trying to inject some AI hype into the stock price?
I genuinely think he means every word of it. You have to look at his historical track record to understand his conviction. He has more than earned his stripes as a wartime CEO. Back in 2022, when the tech market crashed globally and literally everyone in the financial media was saying Sea Limited was going bankrupt because they were losing billions of dollars a quarter, he didn't panic. He ruthlessly pivoted the entire massive ship in the span of about 6 months. He cut costs, he pulled out of losing markets, and he managed to turn a massive profit significantly faster than any analyst on Wall Street thought was mathematically possible.
That turnaround was truly legendary in the tech space. Going from massive existential losses to posting record-breaking profits in under 2 years is a case study in execution.
It really is. So because of that track record, he has earned a significant amount of benefit of the doubt from institutional investors. When a CEO who executed a turnaround that flawless says that agentic AI is the next industrial revolution, and he is willing to bet the future architecture of his company on it through a Google partnership, the market takes it seriously. They aren't dismissing it as hype, they just want to verify the upfront cost.
So bringing this all together, what does this actually mean for you, the listener, as you look at your portfolio? You have a company currently trading around $115. The smartest analysts on the street think it should be valued closer to $180. They are sitting on nearly $10 billion in pure cash. They are clearly dominating e-commerce, gaming, and fintech in one of the fastest growing regions on Earth. But they face a massive, well-funded competitor in TikTok Shop, and they're essentially betting the farm on an unproven AI transition.
If you are an investor looking at taking a position in Sea Limited today, you have to understand that you are buying the entire interconnected ecosystem. You are placing a bet that the flywheel is real, that the gaming profits funds the e-commerce logistics, the e-commerce scale feeds the fintech data, and the fintech arm monetizes the entire loop. You are betting that the ecosystem is exponentially stronger than the sum of its individual parts.
Right.
And critically, you are placing a bet that this new agentic AI infrastructure is the ultimate grease that will make that exact flywheel spin faster and cheaper than ever before. You have to believe that Forrest Lai can navigate the TikTok subsidy threat with the same operational genius he used to navigate the 2022 market crash.
It really does feel like a monumental, pivotal moment for the company. The Q4 earnings call on March 3rd isn't just going to be a recap of the last 3 months of sales. It feels like it is going to set the entire narrative trajectory for the stock for the next 3 years.
Absolutely. If you are tuning into that call, pay close attention to this specific GMV growth guidance. Watch their sales and marketing spend line items closely. Are they burning precious cash just to fight off TikTok? And listen very closely to the tone and the details they provide about the Google partnership. If they can show even a hint of immediate ROI on that AI expenditure, the skepticism that dragged the stock down 6.9% this month could evaporate very, very quickly.
Well, I, for one, will definitely be tuning into that call. It is shaping up to be a completely fascinating week for the broader markets, and especially for Sea Limited.
Absolutely. It's going to be one to watch. Thanks for having me break it down.
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Until next time.
Thanks, everyone.
This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.